It's trying to spin the dovish hike, really difficult to do. So the market's trying to figure out how to calibrate all these things. Higher inflation but coming down, credit conditions tightening, which are already much tighter, by the way, over the last few months. So future tightening, I think, is on tap. And tie that into where the Fed goes, not so much today, but over the next 6 to 12 months. So I think this dovish hike narrative probably is not going to stick as much as the Fed might like. It weakens the economy a bit quicker than I think a lot of people expected. Interesting, the Fed's own dots show just a little bit lower expectations for growth this year than they had back in December. I think the Fed is not really giving enough credence to the idea that tighter credit means things weaken in a fairly quick manner.
If I can continue from here, okay, this is the this is the S&P 500, right? It's going like that, probably. Yeah. So I just try to explain based on using this methodology based on a historical pattern, right? And how to explain it, what probably will happen in 2-3 months time, or maybe in 1 year time. Okay. Looking at the big fear has subsided here. Looking at this, without any further, I would say, bad fundamental in the market, probably that will not create a big casualties, I would say, and the market will be moving very volatile, but probably in uptrend. And again, like what Sean have said, also we don't have any preference whether up or down, but we just simply explain what the chart has been telling us so far.
If you have been following the market, the S&P 500 lately, you realize that it has been bouncing back since the mid of October 2022 after hitting a low of 3,580 on October 12. And then it goes all the way up till today at the highest point around 4,600 level. And the question is that, can you believe it? That's crazily up by 27%. And that's the reason why you need to stay up till the end of this episode, because, well, you will learn that the market has bubbled and you have the information in hand first. Now, those of you who have been following my posts on the 30th of March, around 4 months back, with the big money flow analysis, I've told you that the market will rally up till further notice. And today is probably the day that you want to be careful. And I would say that by using the Fear Barometer analysis, you will find that the market is totally overhyped. So if you want to top up positions or start accumulating position or liquidate partially or all positions, then you must know what are the risks in front of you. Well, there are a couple of reasons why investors want to be crazy with the market today. First, now we are still in the midst of Q2 corporate earnings seasons. So far, the outcomes are still kind of mix of positive and negative results. Some companies announced good earnings, while others reported that they fell short of expectations. In general, I would say analysts are projecting about a 5.6% decline in earnings for the S&P 500 compared to the Q2 last year. So the earning might not be as bad as what they really anticipated initially. Then in general, the June employment data was positive. The economy is still kind of creating jobs and wages are rising. To represent layoff information, Labor Department reported that initial claim decreased by 7,000 last week on Thursday. It's kind of reaching a seasonally adjusted of 221,000, which is historically low and closely aligns with the 2019 average when the labor market was strong. Well, Labor Department also reported that the inflation-adjusted average hourly wages rose 1.2% in June from a year earlier. And this is a positive development, represented the second consecutive month of seasonally adjusted gains, in which the increment is higher than the rate of inflations. So wages grew by over 4% while consumer prices rose to only 3%. Now, when you look over consumer spending in quarter two, well, I would say it grew, but at a slower pace for both goods and services. A better trend here, I would say, was a business investment, which strengthened from April through June. Business investments grew at the annual rate of 7.7 in the second quarter, up sharply from 0.6% in the first quarter, with companies spending solidly on buildings and equipment. Companies rebuild inventories. As you can also see, there's a little heartbeat in the chains of private inventories. And this is important because probably they're just expecting higher demand that can boost the economy and market confidence. So if you look at the final sales to private domestic purchases, which measure both consumer and business spending to gauge underlying demand in the economy, it grew at 2.3% annual rate in the second quarter. But it is a slowdown from 3.2% growth in the first quarter. So yes, the US economy picked up last quarter with GDP growing at 2.4% annual rate, just coming up from 2% growth. But I would say that the overall trend is still kind of clear to me that it is still trending down. So while some investors think that the market is clear from a recession, thinking of having some good soft landing, and they just want to act bullish, I just still want to be a little bit careful here with the markets. And judging at the overall trend, I would say that it is still better to be safe than sorry. And most importantly, I want to show you that by using Fear Barometer analysis, you'll see that being bullish over the soft landing story might not justify the current stock market level. So how to use the Fear Barometer analysis? Well, Fear Barometer analysis is a moving average that tracks the change of the daily price fluctuations, which is the S&P 500 in this context. So if the moving average of the daily price change is positive, then we draw a circle or a dot, or we call it a bubble above the zero level. And if the moving average of the daily price change is negative, then we draw the bubble below the zero level. So while the y-axis is just to measure the moving average of the change of daily price, the zero line, or we call it the x-axis, will correspond with the market price level. So at the given price level, when it has a more positive bubble, means that the market has less fear. On the other hand, when it has more negative bubble, means that the market has more fear. As the stock is not a pure science, the use of a fear barometer will be more optimum in a more extreme scenario. So for example, when the market has no fear at all, or is 100% full of fear at a given price, this would indicate that the market is overhyped in fear or in greed. So if you follow Warren Buffett to be fearful when others are greedy, or being greedy when others are fearful, then what I'm going to show you shortly is going to be an opportunity for you.
People behave very peculiarly in terms of the reactions, because they're human beings, and they get excited when others get excited, they get greedy when others get greedy, they get fearful when others get fearful, and they'll continue to do so. And you will see things you won't believe in your lifetime and securities markets. I wrote an article for Forbes in 1979. I just said, how can this be? Pension funds in 1970 put 100 and some % of their new money in stock because they were wild about stocks. Then they got a lot cheaper, and they put a record low in, 9% of their net new money in 1978 when stocks were way cheaper. Investors behave in very human ways, which is they get very excited during bull markets, and when they look in the rearview mirror and they see a lot of money having been made in the last few years, they plow in and they just push and push and push on prices. And when they look in the rearview mirror and they see no money having been made, they just say this is a lousy place to be. So they don't care what's going on in the underlying business, and it's astounding. But that makes for huge opportunity.
We see the market, the S&P 500 experienced a peak on 3rd of January 2022 at 4,796, and it started to slide down, reaching the lowest point on 12th of October 22 at 3,577, and that drops is about 25.4%. Well, on 26th of July 2023, the S&P 500 was around 4,566, which is effectively at 4.79% from the 3rd January 2022 peak, which was around 4,796. Now, every downtrend or uptrend, there will be days when they are down or negative and some are up or positive, but if you count the ratio of down days versus the up days during the downtrend from 3rd of January 22 till 12th of October 22, which are 195 trading days, the ratio is 1.35. Now, when you make the ratio of up days versus the down during the uptrend from 12th October 22 till 26th of July 23, which are about 196 trading days, the ratio is 1. Well, I would say that this is a little bizarre to encounter an uptrend in which the ratio of up versus down is 1, which means it is about 50-50. Usually the healthy uptrend would be about, I would say, 55 to 45 or 60 to 40. So the ratio is just about 1.2 or 1.5. So, well, look at the downtrend, which the ratio is about 1.35. It looks normal to me, but not the uptrend. So the way how I interpret this, that there is a strong pessimism still about the uptrend today. If you calculate using the regression line during the downtrend, the slope was about negative 4.18 and the uptrend is about positive 3.24. So in terms of the strength or the intensity, they are very close. Probably about, well, 22% difference if you take the downtrend as the base. So the nuance of the joy that we have today is almost the same as back during the downtrend corrections. Now, when you look at the table over there, we track the daily price of the market, the S&P 500, and we track its daily positive and negative changes. Then we try to smoothen out these daily changes by moving average down. So when we move average our daily price changes, we just want to underweight the daily price fluctuation so we don't encounter any choppy situations here. Now, when you plot and map these informations into the Fear Barometer, you got your bubble in both positive and negative zone in general. But this bubble chart is to capture the sentiment during the downtrend from the 3rd of January 2022 to 12th of October 2022. And when you look at the chart, well, you see that there is no positive bubble in a range of 3,600 to 3,800 level. So this indicated the extreme fear that happened in the markets. In fact, I'm not sure if you can see as I can that the concentration level of the positive bubble from 4,007 to 3,900 is getting less and less concentrated. But the negative bubble concentration is getting more and it's getting stronger. Towards the 3,800 and 3,600, in which you couldn't find any more a positive bubble, which we call it this situation as the extreme fear. So the price sold between 3,800 and 3,600 was probably kind of oversold, and this explains why the reversal happened afterwards on the 12th of October 2022. Now, let's use the Fear Barometer again to analyze what happened with the current uptrend. A similar things happens, but in the reverse. From the 3,700 to 4,100 range, the bubble is spreading across both positive and negative zone. But as the price is heading towards the 4,100, bubbles are still spreading across the positive zones. But the negative ones are getting less concentrations, and after around 4,200 level and above, well, you see that all bubbles are concentrating at just the positive zones, and we call it the extreme greed. And you need to be extra careful in these situations. Now, let's take a look back historically at what happened when the market was in the extreme greed. Now, take a look back at the previous peak. So, if I picked up dates between 15th of April 21 to 3rd of January 22, you see that December 21 was still a strong market. At the time, the market reported a strong US economy, which grew at annual rate of 6.9%. The unemployment rate fell to 3.9% in December 21, which is the lowest level since February 2020, and corporate profits rose by 19.7% in the third quarter of 21, which is one of the fastest pace since 2010. So these are the reasons behind the peak. But if you refer to our Fear Barometer at around 4,007 to 4,800 level, that was a price level driven by the extreme greed and then followed by the 20% correction in the year 2020. Now, probably you might have questions like how deep the corrections could potentially be. Well, take a look from 23rd of March 2020 to 15th of October 2020 at Fear Barometer chart. 3,450 level and higher was the level driven by the extreme greed. But the big difference here was from 2,700 level to 3,450 levels, the negative bubbles concentrations was quite well distributed. Even they're getting more towards the 3,400 level. So in this scenario, we also want to understand a little bit of the context of why it needs to be speculative at 3,400 level. Well, if you refer back to the previous peak before the COVID-19 market collapse, it was at the highest of 3,380 level. Therefore, the first mover in the market speculated at the 3,500 level, and then the rest just followed. But again, you will still see that there was a bit of corrections there since the market dropped to 3,200 level, which is about 10% corrections. So in this scenario, the extreme greed still gives you a warning alert. But understanding the bubble concentration in the market context might give you a clue of how and what kind of corrections you might encounter. Now, let's analyze how the Fear Barometer reacts during the COVID-19 market plunge. Let's take a look at the chart between the 1st of June 2019 and the 20th of February 2020. There were two of the extreme greed warning signals given. The first one when it was around the 3,150 to 3,210 range, and the second one when it was around 3,300 level and above. So earlier, around 2,900 and 3,000 levels, the bubble was well balanced in both positive and negative zones. But as it is moving towards the 3,100 level, I would say there was almost no negative bubble here. So the first extreme greed, well, it causes a small correction around 23rd of January 2020. But the extreme greed comes again for the second time around the 3,300 level, and this time round the market plunged to about 35% corrections. Now, let's understand by using the Fear Barometer that what kind of uptrend that gives you the uptrending continuity. Now, let's analyze the market from 23rd of September 20 to 11th of May 2021. First, can you identify the extreme fear spotted around 3,250 to 3,400 level from the Fear Barometer? So if you think the price was undervalued, then you probably want to ride on the market till around 4,200 level. Then you start to think about what next, either to hold on or sell off. And when you look back at the Fear Barometer, although it is going to be much better scenario to spot more negative bubbles at the 4,200 levels, but it was not a state of the extreme greed. So in these situations, at least, I won't be expecting any significant corrections. And apparently the market still rallied up at the time. So up to recently, 26th of July, this is what the Fear Barometer looks like. And please do let me know in the comment below, what do you think about the market tomorrow?